here with two of our great speakers and commentators. Everybody knows, everybody respects globally. Mike Muller, head of Vitol in Asia. Christophe Roule, senior research scholar, Center on Global Energy Policy at Columbia University. We kick off the new year, would you believe it, with oil prices back at where they were before Omicron, which is what Mike and Christophe were just talking about. So we would have to say we start 2022 in a post-Omicron age, even though it would appear that the infection rates everywhere are in very big numbers. But the impact, the consequence seems to be not quite as bad as maybe was expected when crude oil fell over $10 a barrel at the end of November on the threat of Omicron. We've now come through the threat, and it would appear that oil prices are back at $86 a barrel because Omicron hasn't knocked the world over. Let's kick off with Mike Muller, sitting in Singapore. Good morning, Mike, as you wake up this new year, $86 on the barrel. What's the first question to ask? I mean, what does the year ahead look like? What are the big ideas? Are you surprised to see prices back at these levels, given the sort of general outlook, supply and demand?
Yeah, I mean, let's just repeat the numbers. I mean, $86.50 Brent is pretty much the highs of the move in October last year. And to go back to when we were at or above that level, there was an $86.70 print in, I'm looking at it here, in October 18. But then any higher than that, you have to go back to 2014 when prices fell off that plateau they'd established for about 4 or 5 years at $100, $110, $115 a barrel. So we are pushing towards this triple top of the market and possibly new highs. But WTI is close to $84 a barrel. That's come along even faster. And of course, given you have a much more responsive upstream scene with investment prospects in the Permian Basin there, that's incentivizing drilling and so forth. And the other one we need to start mentioning in the same breath, of course, is European gas, which has been making all the headlines while you've had your recess here on these sessions, which had gone as high as 180 something euros per megawatt hour, and that's now sitting at 83 as well. So those markets have definitely been extremely active and volatile. So am I surprised was your question? If you look at global inventories of oil and you look at the success of the OPEC plus concerted action to take inventories down to pre-pandemic levels, I mean, OPEC succeeded many months ago, but are continuing to forge on with their policy, so much so that many of their producers can't really put their share of the 400,000 barrels a day monthly increase into the market any longer, which has been a theme for many months already on these calls. The price is therefore very much in the hands of core GCC, and you can argue Russia, but global inventories are below pre-pandemic levels. And in many cases, there are pockets of tightness, which would have you say that a front-end backwardation and a strong market is very much justified. In fact, to put it very generically, there is only really one part of the world that has spare capacity in terms of refining capacity and in terms of inventories, and that is a part of the world where data is a little bit less readily available on a real-time basis, namely China. But in the rest of the world, you have a phenomenon in Europe where, despite the fact that the piece of the global demand barrel that is still missing is jet fuel, you have the regrade, as we call it, the differential between jet fuel and diesel, trading positive in Europe for the first time in a very long time. It's still inverted, it's still negative in Asia, but that tells you there's not enough jet fuel around in a market that is still missing a huge piece of aviation demand. 0.5% very low sulfur fuel, which propels ships, is tight. The inventories on that product are back down to the sort of levels we had pre-IMO when the world was panicking about whether we could make and blend enough of that. And I could go on and on. There are some pockets of the energy complex that are less tight. I mean, margins for olefins, so for petrochemicals, are less stellar. So that has naphtha being one of the weaker products out there. But I could go on and on and on. Our half an hour would be up here if we're not careful. So it is a very, very tight fundamental market, which underpins the backwardation we're seeing at the front of the market, which is 50, 70 cents at the very, very prompt, but then 80, 90 cents per barrel per month going into the back months. I think, yes, these prices are justified. And I think the fact that we've had a lot of risk off mindset at the end of the year, there's a lot of managed money sitting on the sidelines that might say, hang on, oil looks like it's about to pop towards 90 and maybe even through that level. Let's not miss out. And if that money, which is currently on the sidelines, comes back into oil, there's a very real prospect of us
Well,
making.
we're already seeing a big surge in open interest over the last week or two. Christoph, it does appear that the big story of the new year, inflation, 7% printed in the US, and now talk of an even more accelerated tightening cycle, doesn't seem to be disrupting the momentum in oil at the moment, but certainly starting to impact other markets. What are your thoughts, given that macro picture, all things inflation and monetary policy at the start of this year?
Well, usually, good morning, first of all, to you and everybody else, and still a Happy New Year, even if it's late.
Yes, exactly. Happy New Year.
Usually, in what we call normal times, oil and oil prices are the consequence and not the cause of whatever happens on the macroeconomy. Luckily, it's rare that oil prices are getting so out of whack that they have bad macro consequences. So, and I would expect 22 will be a very interesting year indeed, because as Mike said, high prices are justified. I know it's a testament of what OPEC Plus wanted to accomplish, the backwardation which we are seeing at the moment and the price level which we are seeing. In 22, what we will have is like three forces on a collision course, and it's interesting how it will end. I have my own opinion. But one is the tightness of supply, which will happen once spare capacity is actually used up, which now, depending on whom you believe and whose demand forecast you believe, will be somewhere between September 2022 and spring of 2023. And by used up, I mean down to 2 million barrels per day, which is the usual safety cushion. Second, we have reactions, of course. The prices can't go up forever without supply reacting. And that supply we are particularly interested in this juncture is the shale in the US, and we are seeing rig count going up. We're seeing fracking teams going up, but still on a slower pace. But there is no doubt, I think, for all of us that eventually it's just a matter of how big the carrot needs to be for these guys to jump in. And don't remember, they haven't spent the last 2 years sleeping. They have increased their efficiency a lot, so they can now sustain production with a lot lower oil prices. So if there's a cyclical reaction, they're better prepared to continue producing with their now proper boards and decisions and everything in place than they were 2 years ago. And then the third aspect of that is the key question, bringing those two things together, the speed of demand, and that's a question of the macroeconomic environment. I still think that with the Fed interest rate increases looming, and COVID now hopefully out of the door and forgotten soon, that we will see again an acceleration in demand in the early part of 22, but then a slowdown in the summer. And in particular, what I think is important here is not to lose sight of the fact that oil demand is actually in secular decline already in most OECD economies, including the US. And the big demand center accounting for half of all demand growth globally is China. And what happens in China is fraught with problems. I personally believe that they will continue their zero COVID policy until the Communist Party Congress in October, November, which is a very important date for them, because that's the Congress which will confirm the present president for 3 terms in office, something which hasn't happened since Mao and something which he clearly thinks he's in a tradition of. And he won't allow COVID to derail that show before. And that will have a high economic cost. And that very high economic cost in turn may derail the Chinese temptation to run a tight monetary and fiscal ship to clean out all their financial problems in the real estate sector and the zombie banks, meaning that it is possible that we see a further deterioration in Chinese economic activity till the summer, and then a boost when they take a page from everybody's playbook and give themselves a huge monetary and fiscal stimulus. That's something which people haven't gotten around to, but I think this is likely to happen.
Mike, before we get into China, which obviously I want you to jump in on, I first want to talk about the idea of supply. You mentioned in your first comment about this is a tight market in all of the obvious places. But ultimately, on the basic level of oil supply, every time OPEC Plus increases 400,000 a month, it's another month in which they get closer to their limit, right? To the point at which there is no new supply or extra idle supply sitting on the sidelines that can come in short order. We have Citi forecasting a decline in oil prices through the year because they see supply coming from all the traditional places, Permian, Brazil, Mexico, and so forth. I'm wondering your thoughts on that non-OPEC plus supply as a feature as the year gets underway.
Well, in short, the world needs it. You mentioned Mexico. I would strike them off the list as a place of increased supply. In fact, there's been some talk of them having less to export and wanting to be more domestically focused. There was even a headline about them not exporting any crude at all, which is a theme that there's also surfaced in Indonesia, which maybe we'll come to later. But no, I think all of these new supply sources, the ongoing investment in Brazilian deep water pre-salts, the Suriname and Guyana production, the big Exxon project there, a bit of extra oil coming out of Norway. This is all accounted for, and it needs to be on time. There can't be any delays in these projects coming on stream because the world is counting on having that supply. And that brings us to the more responsive stuff, which is twofold. It's Permian investment, and Christoph alluded to the rig count before. I mean, that will come, but it won't come in the same way because there's just physically no time for us to get a response from the Permian Basin and the rest of the shale sector in the coming months, which we're concerned about. And then what's left is the SPRs. And yes, we have seen a lot of posturing around that concerted effort that the Biden administration led to see some SPR releases in Japan, China, Korea, even the UK on products. And this was obviously taken into account and dismissed. It's in the price, and the market's saying more, please. So what happens if you destock your strategic petroleum reserves too much? That's along with the 2 million barrel day of supply cushion that Christoph was talking about. That is a comfort level or a layer of comfort that will not be there any longer. And some governments won't be comfortable with not having it and dismissing it. I mean, you can talk about Japan not needing it anymore with a sort of stable economy and an arguably shrinking population. But in places like the US and China, it's still extremely important to have these SPRs in place. So yes, the market is now at this $86.50 Brent level with SPR releases priced in. And the question is the Biden administration going to release even more? And what sort of response will they evoke? I think it's likely that there will be more. I mean, a couple of companies drew on the SPRs. They are rather cleverly structured as time trades, as exchanges, where you have to give whatever you took in the current market back in a year's time or so. But it's also fair to note that the uptake of SPR has been less than maybe was initially advertised. And we need to watch China because China is a lot less interested in releasing SPR in the low 70s than they might be here in the mid to high 80s. So it is quite likely that some will come there. But again, I'll keep coming back.
Even that big announcement last year with the SPR release, the market sort of took it and shook it away, really. Even that sort of, although China wasn't formally part of the announcement, but ultimately the market would seem to indicate that it's nowhere near a scale in which would change the trajectory of the market.
Well, we have to be, sorry, did you?
Yeah, go ahead, jump in.
We have to be careful on two fronts here because number one, the SPR release to some extent, was carried out by getting products out from commercial holdings. And that to some extent helps to explain the current tightness, which we also see on the inventories for products, not just for crude. But leaving that aside, if you go back to this mental model, and if we have really three forces at play, then we can also look at them and see that this is more or less now a temporary collision course here, not a secular problem. So what we have, one item to think about is the degree to which OPEC spare capacity is being eroded. That is taking place. The second item we have to look about is the degree to which supply elsewhere responds to the high prices. That is taking place, but Mike is right, it takes place much slower than probably the first item. And so that points at some crunch time coming in the spring or whenever the erosion of spare capacity becomes obvious. And the third item was the demand for the year, which is a function of economic growth. And that's where I see a lot of very high-end estimates. And even if they are correct, they all agree that this is a sort of a blurb in demand going up very steeply now and then coming back down at the end of the year and the beginning of next year as this flash in the pan of post-COVID growth evaporates. And when you look at serious forecasters like the EIA, not the IEA, the American Information Administration, they forecast actually lower prices in 22 than in 21. And in particular, they base that on a slowdown of demand towards the end of the year. So from my perspective, this looks more like trains on a collision course, which then can safely pass each other in the night if somebody is manning the station where the trucks are redirected, so to say. If we can get over this crunch time now at the beginning of the year, when we have a collision of erosion of spare capacity, slowed supply response, and very strong economic growth, and get to the other side when all these things are becoming a bit more normal. And that can be done, of course, because for that, we have a safety cushion of 2 million in Saudi Arabia, not just the SPR.
Mike, I want to just switch a little bit to the China question, but also within the context of it as global growth. I don't think it's been a long time, both coming out of a year in which Chinese oil imports have declined year on year, and it's a long time since we started a new year in which the Chinese economic outlook looks for the first time somewhat precarious and unpredictable. We had, as part of our forum last week, a fairly respected voice on China, Xavier Chen, a former head of BP in China and so forth, calling that we have reached China peak oil demand at 14 and a half, 15. Your thoughts, Mike, start of the year, looking out to China, where it is, where it looks like it's going vis-a-vis energy demand, but particularly oil?
Yes, I think that's a bold call to say China's already at peak demand. I personally cannot see it. Yes, it is fair to say that China is right at the forefront of transitioning certain segments of their energy consumption economy. And from a geopolitical standpoint, it's something they clearly would like to do. But I cannot see how China has already peaked in terms of its oil demand, given that they're bringing on stream new refineries and new petrochemical facilities. And they have a currently semi-idled independent sector, often referred to as the Shandong teapots, and a few in Liaoning as well, which still have a lot of spare capacity. And I only just a few minutes ago said that the world will need that capacity to kick into gear in order to supply itself. So China is grappling in the lead up to the party conference in October that will indeed serve to reconfirm Xi Jinping's longevity in power.
Coronate, is that the word? Coronate?
Whatever.
Yeah.
With a triple challenge, right? They are enforcing a policy of suppressing COVID, and they're facing a challenge there, which we'll need to come on to. They want to do something about deleveraging overheated, over-leveraged sectors, most visibly the property fiasco, which is a face-saving matter, I think, in terms of reassuring investors in China. And they want to sustain growth in the economy. And it looks like having all three of those pinned down for the rest of this year is a major challenge. But I don't think we need to get ahead of ourselves on China and COVID letting rip through China yet. I mean, the case count is still around 100 a day for a country of more than 1.4 billion people, with very, very high barriers to entry for the virus. I mean, colleagues of mine need to spend 3 weeks in quarantine if they return to China from visiting relatives in Singapore, for example. So yes, there have been some very high profile cases of people moving around China, transmitting Omicron from one place to another. We had our first case in Beijing yesterday, but we're nowhere near China seeing a major demand hit. The city of Xi'an, like 13, 14 million people, closed down for the best part of 3 weeks. It's beginning to open up on a district by district basis now. And there's a clear difference in policy, I think, between Shanghai and Beijing, which cannot possibly be closed down in their entirety, and the provincial cities in the rest of the country, which can. So you have a largely vaccinated country, albeit with a non-mRNA vaccine that has a lower efficacy, and the transmission data is still very, very non-troublesome. But people are already speculating what happens if you get a major outbreak in a Chinese port. And of course, Tianjin on the doorstep of Beijing has had cases and has seen measures to lock things down. So people are already speculating on what would happen if you had Omicron hitting a major Chinese container port, and what that means for the supply chain, for consumer prices, and for inflation in destination markets for Chinese goods. But I personally think we're still quite far from that. China obviously has had policies in place to protect reputation, nothing more so than the Olympics, which kick off in less than 3 weeks' time in Beijing. And whilst it looks inevitable that Omicron will take hold in a greater way in China, it doesn't look impossible for the Chinese to continue to contain it by imposing these bubbles and advising their population to restrain their travel plans over Chinese New Year. So it looks like it will be a...
Mike, that's the wrong question, isn't it? What people are saying is that precisely because they will try to control Omicron success or not, that will dent economic growth. And you can see it in the numbers. You can see it in oil imports, and you can see it more to the point in Chinese consumption data, which is growing very, very, very little. Tomorrow, the fourth quarter GDP numbers are going to be published, and you will see it again, even when the Chinese try to put a brave face on it. It's not that it's too big to be hit by Omicron or something like that. Precisely because it's so big, it will not escape Omicron. And nobody says about all of China collapsing because of Omicron. People saying the current lockdown policy has economic costs which become too high over the summer to account for the growth rates which have been projected. And that will cause a change in policy. What could it be? Either giving up on the lockdowns like the UK, or coming up with a stimulus which has its own risks and its own advantages, but will change the game globally.
I suppose, Mike, the sort of the peak demand point that Xavier was making is clearly a call that one can pontificate on. But just looking at the year ahead, given all the dimensions that you just articulated, would you expect Chinese oil demand to grow again on 21 levels, or be same, or where do you see the average over the year, given that this was the first year of decline since records started 20 years ago, into 22? What's your outlook for the year?
Given what we're seeing, it doesn't look like China is going to shrink its demand. I agree with Christoph that the growth rates are not what they are, and we will see the manifestation of lockdowns and cancellations of flights, etc. But it's still not happened on a large scale there. I mean, it's 2 months ago, many cities in China were not even wearing masks in terms of the majority of people out there. That has changed. I mean, it's kind of convenient in cold weather as well to have a mask over your face, but it's been a society that's been relatively COVID-free and carefree about things. And with the issues in the property sector aside, many other sectors of the Chinese economy have still been looking pretty robust. So it is very hard to see a shrinking China.
Okay.
Of course, it is. There are many people, representatives of many companies out there that would like to paint an energy transition scenario because that's the right thing to say in terms of their investor base and global society, global opinion. But the fabric of Chinese society is still heavily oriented towards manufacturing and energy-consuming businesses. And yes, you will see a blip in Q1 as well, not just the Q4 data that we'll see tomorrow, because China has shut down already many emitting, polluting industries around Beijing to keep the skies blue for those Olympics. But no, I don't see China shrinking at all. Cannot.
Javier was basing his forecast also on the number of EVs. And that is certainly, I think, a miscalculation, because China is a country where the car fleet itself is still growing. So even if EVs grow, there's scope for others to grow with it. So
in terms of the wider growth, global growth, Christoph, we have the World Bank downgrading their outlook for the year, the world growth generally softening, and significant revision down. And at the same token, we have central banks, Christoph, your view, but that say potentially losing control of the fight against inflation, the Fed being the most significant. In each month that's gone by, they're sort of scrambling to catch up. Oh no, it's not going to be 3. It's not going to be any rates in 22, and it's going to be 3. Now it's going to be 4. Your thoughts of the consequence of the year ahead, if indeed the Fed has to aggressively push on the brakes?
It's going to be a difficult year and difficult to estimate. And the reason for this is that if one word characterizes it, it will be sort of increasing fragmentation or deglobalization, if you want. But we see that on different levels. We see the Fed going ahead, but the Fed obviously also has a bias. So I have a hard time envisaging the Fed doing 4 or 5 rate increases to really kill inflation. I think most of the US financial sector establishment would be quite happy with rates of 4 or 5%, taking care of some of the debt and keeping the financial markets afloat and preventing derailing of stock markets. And that's the more likely outcome. Yet this doesn't really help Europe. This would be the time normally for a switch where the engine of growth goes from the US back to Europe of global growth. But Europe has an inflation problem building up and an ECB which will not do anything in the foreseeable future, so that even if the Fed does too little, it will still widen the gulf between those two. And then you go further east. On the other hand, you have China, which is entering sort of uncharted territory. And China may have strong industrial sectors as long as global demand is strong. But that's what feeds the beast right now. Their domestic consumption has all but not collapsed, but diminished severely. And it's not true that it has problems only in the real estate sector. China has problems with municipal lending, with zombie banks, with leveraging in the financial sector and the real estate sector, 6 or 7 different hotspots. That's why they are trying to be tough, and they may have to derail that and allow for more inflation. And in the midst of all that, when I was typing emails with New Year's wishes, and what do you think about this litany of words like happy and enjoyable and healthy and whatever you wish the other, all the time peaceful crept into my mind. And that's of course partially because of the situation which we have now with Russia and the Ukraine, the return of just blatant threats with war as a means of policy. So all of that is what I mean by fragmentation, and none of that is good for economic growth. And so my expectation for growth this year would be, yes, we will see the most likely straw fire of the pent-up demand post-COVID now, and high growth into the summer. And then there is a very high, nobody can tell, but there's a very high probability that growth will severely disappoint. So I'll share these downgrades from the World Bank and others and where they come from.
Let's get the survey question in before we lose out of time. We did have our own survey last week where we were asking the outlook for prices for the average for the year. And we got 45% saying closer to 80. But I'm keen here to really focus more on the first quarter. What will be the average price of Brent crude oil in Q1? We're obviously well above 80. So it would have to come off quite a bit to get an average. But nonetheless, I'm looking for that average over Q1. Is this sort of rising tide going to sustain? We've heard about China looking uncertain, certainly in the first quarter. We're not going to have a bumper sort of New Year demand surge. That's a Chinese New Year demand surge. So where do you think the average price of Brent crude oil goes in Q1? Closer to 85, closer to 80, 75? Choose your number, and we will close out the comments for today. Mike, obviously there is a number of factors looking ahead. Obviously, conflict in the potential of in Ukraine and Europe. Where else would you be looking at the start of this year? For obviously the Iran nuclear talks, every second headline seems to contradict the one before. Yes, they're going to do a deal. No, they aren't. How significant that would be from the point of view of the supply beyond OPEC plus?
Yes, I'm glad we've turned to geopolitics because it's really important, and it is underpinning this price surge. There is a bit of a geopolitical disruption premium there too. So you mentioned Iran. I mean, the big question, I guess, is how high is it up on the agenda of priorities for the Biden administration right now? And Joe Biden and his team haven't had the greatest of weeks. They've had a whole bunch of setbacks internally. There's no way that he's going to be able to push a softening of stance and concessions to Iran through the House. He just won't get bipartisan support for anything like that. But there was a lot of talk from some commentators closer to Iran that there is a new willingness on the Iranian side to see if they can cut a deal as they move closer and closer to having that threat up their sleeve, which is to have nuclear weapons capability. Now, there are some who are arguing that if given a free drop, the Biden administration in Tehran would get it on and do some sort of less for less deal, as they're calling it. And I think the market mood, the market thinking is that we will not see any Iranian oil come into the market over and above what's already leaking out, and sanctions not being enforced on some of those flows, by the way, until maybe Q3 this year or something like that. So the price that we're seeing now includes some people adopting a view that maybe you'll see the return of Iranian volumes sooner. But the question is in what shape or form. If they can't be done in a sanctions being dropped way, is the US going to just allow Iran to bleed more exports into the market, even more so than is the case now? Because you are seeing in excess of 1 million tons a month of fuel finding its way into markets without any sanctions being imposed, on top of the crude oil flows that are being given blessings. And of course, the diluent, also known as South Pass condensate, that's being shipped to Venezuela to help restore production off a very low base there in Venezuela. So that's Iran. Big question mark there, but most most consultants seem to think that we'll get Iranian oil in the market in a significant way sometime later this year, and that, I must emphasize, is in the price. But I have to come back to Russia because, of course, that's been the focus of attention around gas markets as well in a very big way. And in gas markets, the hype in prices has definitely led to demand destruction in various sectors. I mean, some countries that just couldn't afford $40 per MMBTU gas just impacted their high energy consuming sectors. The textile sector in Pakistan is way down on what it would normally be churning out. Manufacturing of fertilizer, urea, expensive, dropped. I mean, even across Europe still, there are certain industries that are not churning out things. And that inventory that's not been made is going to have to be replenished at some point. But it does serve to remind us that people will abstain from buying expensive energy at some point. And the question is, at what point does that kick in for oil? Much less evidence of that so far. So I'm afraid I voted at the higher end of your spectrum in that poll you just did. But the cyber attacks on Ukraine in recent days are a reminder that it's not about military force. I personally do not think we're going to see Russian tanks rolling into the Ukraine, causing an international provocation, because all that's going to do is take the rest of the Ukraine, the Kiev and the western parts, into an even more amenable towards NATO stance. And I think Russia's objective is to avoid encirclement by NATO forces in former Soviet Union republics. So I think it's a very delicate balance there, and I don't think we're going to see a military action of that sort. But the Kazakhstan incident, where the international community, in fact, welcomed the action, despite the fact that there are now allegedly 200 and something casualties, and the restoration with the loss of only one Aframax worth of oil, it seems, throughout that episode, serves as a reminder that, I mean, Kazakhstan and Russia are pretty close. Yeah.
But it also tells you that there's a lot of problems around Russia. You know, Belarus still bubbling away, Ukraine, now Kazakhstan. I mean, these seem to be stacking up like airplanes. Let's go to the survey result and give Christoph last word today. Consensus in this room, closer to 75, closer to 80, 85, spread across the board there. I suppose his price could go anywhere, but I would tend to agree with Mike. It's hard to see it, at least over the first 3 months, on the average, drifting too far away. Christoph, this is a big week to get guidance of where monetary policy is going to go. With the Bank of Japan meeting this week, we've got China, as you mentioned, GDP results coming out, which will indicate whether they have the ability to go softer on monetary policy. Your thoughts looking ahead as to where the direction goes, particularly around monetary policy, and are you think there is anything there to be concerned about in terms of a hard landing?
I don't think it's such a big week for monetary policy. The Chinese numbers are GDP numbers. The Fed discussion will continue.
Yeah, but the Chinese numbers, if they're weak, they'll give an indication that they have the ability to, to stimulate further. China's
Economic Development Commission has made it, to which the central bank ultimately sort of reports, has made it very clear that they want to have a harder line. At least, I mean, probably not dramatic increases, but no loosening up, in order to address all these multiple potential fires in their financial sectors and their deleveraging problems. And so I would not expect any reaction in China which is drastic if their hand isn't forced either way. And the hand is forced more likely towards a monetary stimulus if the economy turns down further. But that is probably still some months away until they get this change in mindset. But they're clearly right now bent on doing the right thing in order, with a hard budget constraint on its financial sector, in order to calm down problems there before they erupt. I think it's going to be a continued build-up in what Mike started to talk about, the problems with Russia. And when I read what Putin allegedly himself wrote about the Ukraine, and when I see these kind of completely stalled negotiations, then I would seriously think that there's a realistic probability that Russia is going to cross the border and occupies Lugansk and the Donetsk basin officially. I think that's likely to happen. Whether this will cause the maximum sanctions the US has imposed, which would be quite dramatic, which would be cutting off the gas pipeline Nord Stream, which would be taking maximum sanctions, right? Which would take Russia out of the SWIFT payment system, the international payment systems, are completely unique experiences on the horizon here, is another matter. But the Americans are safely far away enough to probably try for it. The Europeans would not try it, and it further add to this fragmentation tendencies which we see everywhere. But we should not make a mistake. I mean, in a situation where there's clear that the negotiations don't go anywhere because the US will not say, okay, Ukraine is not joining NATO, and Russia will not say, okay, we're fine with them joining NATO. A frozen conflict seems to me the most likely outcome for both sides. It's face-saving. They can bitch at each other for the next 10 years on the back of some poor souls being shot in the Ukraine. And a frozen conflict might involve the military occupation of these two areas, or some sort of fake referendum and declaring them part of the Russian fatherland. I think that's at least a 50-50 probability. If that happens, then the threat of this maximum sanctions, which have been threatened, is also real. And if that happens, we have severe impact on the economy and on energy markets, and they're not good.
Let's wrap it up there with a somewhat of a spread view on oil prices for the first quarter. We have an interesting comment also by James McCallum in the chat room. OSX service sector index in Schlumberger, Baker, Halliburton, etc., is at 65, or 30% of its level 5 years ago. The point he's making is that the service sector cannot respond overnight to any increase in demand. Equipment inventories are down, capital investment into new technology virtually non-existent, capacity to ramp up on the tools simply not possible, i.e., even if there is a price point that brings or attracts others in, that the actual supply chain infrastructure is not ready or able to turn on a dime after they've been suffering quite hard over the last 2 years. A point worth noting, and another reason for perhaps that tightness and upward pressure on this price. I mean, it seems that we kick off 2022 back to trend pre-Omicron, where prices were at these levels and moving in an upward trend line. Is this a return to trend for all of the similar reasons that existed then, maybe even more pronounced now because there's even less spare capacity and more economic recovery? Let's see where the year goes. Mike Muller, thank you so much for joining us this afternoon from Singapore. Christoph Ruhl back in the UAE. We look forward to catching up later in the week. And thank you, everybody, for kicking off your new year at the Dubai with us here. Mike's got his mask on. That's the image of 2022 remains the image of 2021. All the best. Thank you, everybody. Take care.
Thank you.